Hi everyone, Nick here, welcome back. Money market funds are a great option for saving cash. They're generally safe, but there are subtle differences between different funds. In this video, you'll get a crash course on money market funds. We'll not just compare funds and rates at a high level, I'll teach you how to evaluate money market funds and uncover a couple hidden risks many people overlook. I'm going to use Fidelity funds for comparison, but you'll be able to apply this knowledge to evaluate any funds from Vanguard, Schwab, and others. So first, what are money market funds? Well, they're similar but slightly different from bank money market accounts. They hold short-term debt that typically matures in less than 30 days. This generally makes them pretty safe. They're often the core position in many brokerage accounts. Like if you put money into your Fidelity or Vanguard account, it's usually going to go into your core or sweep account before it gets invested. Or if you receive dividends and aren't auto reinvested, it'll usually go to this account. These are the main benefits of money market funds. They're quite stable. The value typically doesn't go up or down. They just stay at $1 and pay a monthly interest rate. They're pretty liquid. You can typically withdraw your money from a money market fund that day and receive the full value in cash. There are some risks with this we'll go over in a minute. They're generally well regulated because they're very important to our economy and financial system and short-term funding markets. They're well diversified. Instead of going out and buying individual short-term debt instruments like T-bills yourself, you can get a diversified portfolio of them in a money market fund. And there are also potential tax benefits with different money market funds. So what are the main risks with money market funds? The first major risk is inflation. Inflation right now is around 6%, but money market funds are still yielding only around 4.5% to 5%. This means you're effectively losing real value every month to inflation. And you also have to pay taxes on the interest from the money market funds, which makes it even worse. The next is interest rate risk. If interest rates go up, your money market fund could theoretically lose value. However, since the debt instruments they use are so short term, this risk is quite minimal. There's also credit risk in money market funds. Depending on the type of fund, you have different levels of risk. If you're dealing with US government securities, the risk is generally lower, but some money markets invest in corporate securities. And money market funds are generally not FDIC insured. The next is liquidity risk. Money market funds try to maintain a share price of $1. You often don't see how many shares you own, it's just a dollar amount. Historically, they've been very safe and very liquid. However, there were some historical instances where funds broke the buck, which means the value of assets held by the fund went below $1, and they had to freeze withdrawals and put penalties on people that were trying to withdraw from the fund. This can happen if a fund is facing liquidity issues. They can freeze your money or impose these penalties. The final main risk is counterparty risk. Credit risk is really one type of this with the securities held by the fund, but many funds will engage in different types of lending, which is often backed by government debt. We'll cover this in more detail, but this poses a risk based on who they're engaging in these lending activities with. And then money market funds are typically not holding the actual assets. There's a custodian that holds the assets for the fund. These are typically very large, secure banks, but it is an element of counterparty risk. Overall, these are quite safe instruments. When everything's going well, there shouldn't really be any issues with these. However, if there's a crisis in the financial system, you might see some of these risks start to materialize. There are three main types of money market funds. The first is government. These are typically backed by US government securities or agency securities. This could be Freddie Mac, Fannie Mae, different institutions that are somewhat backed by the government, but they're not all equal and they are not all guaranteed by the Treasury. Next are prime money market funds, they often hold a lot of government securities, but they also hold some corporate securities or commercial paper. And finally is municipal money market funds that have state and local government securities. And these are quite different since they often have federal tax exemptions. We'll talk more about taxes later. Now let's take a quick look at some different money market funds from Fidelity. I pulled these rates and fees on March 28th, so it could be a little different by now. So first is the Prime Money Market Fund, which has the highest yield at 4.35%. And as you go down, they get slightly less yield and a little safer down to this Government Treasury Fund, which is slightly lower yield. Then you get into municipal, which is special because it's exempt from federal tax, so the effective rate might be higher. Then it's probably not as safe as these US government treasury funds here. And then you also, just for comparison, at Fidelity, you can use these FDIC insured cash accounts in some of your brokerage core positions. And those will have FDIC insurance, but provide a lower rate. They're just there for comparison. A lot of people's analysis of money market funds may end here. They might compare the rates, conclude the differences are negligible, and move on. However, details matter, and they can make a significant difference, sometimes into the hundreds of thousands of dollars over your investing lifetime. My goal is to make you a well-informed investor so you can make better decisions and be more successful at achieving financial independence. If you want to support free financial education, make sure to hit the like button and subscribe. Before we continue with the analysis of the fund, we need to understand repurchase agreements. Now, these are instruments used by some of these money market funds. A repurchase agreement is short-term borrowing collateralized by government securities. Now, these don't have to be short-term securities like the ones held directly by the money market fund. They could be long-term bonds like the ones that brought down Silicon Valley Bank. Now, those long-term bonds would get lent to the fund by a dealer or bank that's basically selling the securities to the fund, which is the investor, for a short period of time. This could be a week, it could be a month, it could be 1 day. The time varies based on the agreement. Then after that time period, the dealer or bank buys them back at a slightly higher price. And that difference is the effective interest rate they're paying to the fund. So now that we know what repurchase agreements are, let's take a look at the composition of these funds. So I've broken it down into 3 categories. We have the US Treasury percentage, the repo percentage, and other. You can see with the funds that are yielding more, they typically have a higher percentage of repurchase agreements. And then when you get to funds like FDLXX, that's where you're going to have almost all treasuries held by the fund with a slightly lower yield. This is called a treasury-only money market fund. It's actually my favorite money market fund at Fidelity. Now we're going to go compare 2 of these funds, SPAXX and FDLXX. So SPAXX, here's the composition. You can see it has 72% repurchase agreements. And it actually only has about 5% in US Treasuries, or 5.5%. The yield's pretty good. The weighted average maturity is quite low. It's mostly under 7 days. You can see the liquid assets is hovering in the 60 to 70% range recently. And you can also look at some other details here. Now, it's always important to read the prospectus, which you can find on this page, and then you can also get the month-end holding reports. So here's the month-end holding reports for this fund. So you can see all the instruments held by the fund as of February 28th. And you can see they have a lot of government agency debt, like the Federal Home Loan Bank. But then where it gets interesting is these repurchase agreements. So you can see in this column over here the effective maturity date and the final maturity date. And you can see this fund actually has some repos that go out into May with Lloyds Bank PLC. So that is a risk, I think, with repurchase agreements. What happens if Lloyds Bank goes bankrupt by that date? Will they be able to buy these securities back? And then maybe the fund loses some value on those securities, and they're long-term debt instruments that might have to be sold. And they're quite volatile with rates going up as they have been recently. I think this risk is probably quite low. I think these funds are probably managing that risk effectively. But this is a risk with repurchase agreements. You get this extra counterparty risk, and then what happens if something goes wrong with that institution? Now, most of these securities are quite strong and well known, but we've seen some pretty strong institutions having trouble lately. So you can just go through these. You can see some U.S. government agency repurchase agreements. So these aren't actually even U.S. Treasuries in all cases. And you don't know what's actually being backed by some of these. Like, what is, say, CIBC loaning the fund? Who knows? And you can get some more details here. When we compare this to my favorite fund, the FDLXX, this is a Treasury-only money market fund. It has a slightly lower yield, but you can see that it's almost all in Treasury bills and coupons with different maturities. The average maturity is a bit longer, but liquid assets are quite high, nearing 100%. And if you look at the composition of this fund, it's actually quite simple. It all fits right on this page. They hold U.S. Treasury bills and notes that mature pretty soon. So when I compare these two funds, there's about a 0.2% difference in their yields. When you compare this to the SPRXX, well, that's the prime one. When you compare it to the government one we were looking at, it's only about 0.06%. I'd rather take that 0.06% lower yield and have all my assets in the Treasury securities, or almost all of them. But that's my personal opinion. Now for everyone's favorite topic, taxes. Taxes are always complicated. They vary by state. I'm going to share what I know, but make sure you do more research and consult a professional for taxes. The interest paid by money market funds is generally taxed like ordinary income. Generally, U.S. government debt is tax exempt in certain states. Then municipal bonds are generally exempt from federal income tax. And then some states like California, New York, Connecticut, they're special and they treat the taxation of money market funds differently than some other states. For instance, there's no tax exemption if less than 50% of the fund's holdings are in U.S. government holdings. And that applies to repurchase agreements. They do not count in this. So those funds we looked at that contain the repurchase agreements are most likely disqualified from these states' tax exemptions. And then if you're in other states, you might only get the percentage that's actually held in the U.S. government securities as a tax exemption. They should issue you at the end of the year a notice that tells you how much is qualifying for an exemption. And then you have to use your tax software or tax professional to figure out the exact details of how to apply that on your tax return. Now, there are also some special municipal bond funds for these states that can be at least partially exempt. Municipal money market funds are a special topic. They really warrant a separate video, so I'm not going to go into the weeds on those right now. So now let's look at how the taxes apply to the different funds. You can probably claim 5% on taxes in some states in these two funds, but I mark them no because that's quite low percentage, or maybe 10% in this one. But this one you should be able to claim almost all of it as exempt from state taxes. So I think that's another important thing to distinguish, and it could make up for that minor difference in the return between these different funds. The municipal bond funds, they really warrant a separate video, but those are often exempt from federal and sometimes state taxes. So money market funds are a great place to store cash for the near term. I caution against market timing and stockpiling more cash in money markets right now just because of the volatility or maybe fear in the markets. I think the best thing you can do as an investor is to create a sound investment plan and stick to it over the long term. I have a video with help on how to create an investment plan, which I'll link above and below. Now, the differences between these money market funds are pretty minor. They're actually all quite safe, quite liquid and reliable. But I think some of these differences are important to be aware of. The ultimate choice is up to you and how you want to prioritize the different trade-offs. Now, I also made a video recently on Fidelity's cash management account, where you can use some of these money market funds similar to a checking account and basically pay bills almost directly from these funds. I went into more details on that in a video I'll link up here and below. Thanks for watching, everyone. If you got value, as always, make sure to like the video and subscribe to support free financial education. Thanks, everyone. Later.